Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
Today we've got some critical financial updates lined up for you. From the Indian rupee sliding to a record low amid escalating US-Iran tensions and soaring crude oil prices, to major developments in India's credit markets, banking regulations, infrastructure financing, and private credit space, there's a lot to unpack tonight.
Absolutely, Vijendra. Investors are closely tracking the rupee after it fell to a record low of 96.8650 against the US dollar, marking nearly a 6% decline since late February. Brent crude has surged more than 50%. Foreign investors have pulled out over 22 billion US dollars from Indian equities and debt, and rising US Treasury yields are adding to the pressure. Markets are clearly worried about inflation, weakening capital inflows, and the impact on India's balance of payments.
And that pressure is intensifying as US 10-year Treasury yields jumped more than 20 basis points in just 4 days, while 30-year yields touched their highest level since 2007. With Brent crude hovering near $111 per barrel and expectations of a Federal Reserve rate hike this year rising sharply, analysts now expect the rupee could weaken further toward 96.80 per US dollar.
The broader concern here is that geopolitical tensions and commodity price shocks are now directly feeding into India's macroeconomic outlook. Elevated oil prices are worsening inflation fears, bond yields remain elevated, and subdued capital inflows are straining financial markets. Investors are becoming increasingly cautious as volatility rises across both currency and debt markets.
Let's turn to the corporate credit space now. India Ratings has placed Tuticorin Alkali Chemicals and Fertilizers Limited's bank loans totaling Rs 80 crores on rating watch, with negative implications, while maintaining the current IND BBB- rating. The move signals rising concerns around the company's financial and operational position and raises the possibility of a future downgrade.
Exactly, Vijendra. A downgrade could significantly increase borrowing costs and hurt investor confidence, especially within the chemical and fertilizer sector. Rating agencies are now closely monitoring whether the company can maintain adequate debt servicing ability, and lenders as well as bond investors will be watching future disclosures very carefully.
Meanwhile, Trident Limited announced its audited fiscal year 2026 results, declared an interim dividend of 0.50 rupees per equity share with the record date fixed for May 23, 2026, and also proposed raising up to Rs 500 crores through non-convertible debentures, subject to shareholder approval at the annual general meeting scheduled for July 31st, 2026.
And alongside that fundraising plan, the company has also proposed reappointing the managing director for another 3-year term from September 5th, 2026 to September 4th, 2029. Investors will now focus on how Trident balances shareholder returns, expansion plans, and leadership continuity in the competitive textile and paper sectors.
Another major highlight today comes from the Reserve Bank of India, which fixed the premature redemption price for sovereign gold bond 2020-21 Series 2 at Rs 15,904 per unit effective May 19, 2026. Online investors who purchased the bonds at Rs 4,540 per gram are now sitting on absolute returns of roughly 250.3%, excluding the fixed 2.5% annual interest paid semi-annually.
Alongside that, Trident plans to reappoint the managing director for a 3-year term from September 5th, 2026 to September 4th, 2029, while shareholders will vote on the fundraising plans and leadership continuation during the annual general meeting scheduled for July 31st, 2026.
Another major highlight today comes from the Reserve Bank of India, which fixed the premature redemption price for sovereign gold bond 2020-21 Series 2 at Rs 15,904 per unit effective May 19, 2026. Online investors who purchased the bonds at Rs 4,540 per gram are now sitting on absolute returns of roughly 250.3%, excluding the fixed 2.5% annual interest paid semi-annually.
That's a remarkable wealth creation story. A Rs 1 lakh investment made 6 years ago is now worth nearly Rs 3.5 lakhs, apart from the regular interest payouts. Sovereign gold bonds continue to stand out as a strong long-term investment option because they combine government backing, fixed income, and capital appreciation linked to gold prices.
In the insurance sector, Geo Allianz General Insurance Limited has officially been incorporated as a 50-50 joint venture between Geo Financial Services Limited and Allianz of Germany, with an initial capital investment of Rs 4.95 crores. The Insurance Regulatory and Development Authority of India has already issued a no-objection certificate, paving the way for the company's entry into general and health insurance.
This is a major strategic shift in India's insurance landscape. Allianz has exited its earlier partnership with Bajaj Finserv after more than 2 decades and is now betting on Geofinancial's digital ecosystem and scale. Industry observers believe this partnership could intensify competition and accelerate innovation across the insurance sector.
The Reserve Bank of India has also proposed a major transparency reform requiring banks to disclose detailed Basel III metrics every quarter in a standardized format. These disclosures would include common equity tier 1 capital, total capital, risk-weighted assets, leverage ratio, liquidity coverage ratio, and net stable funding ratio, along with explanations for significant changes and risk management practices.
Banks will also have to maintain a dedicated regulatory disclosure section on their websites and archive reports for 10 years. This move aligns Indian banking standards more closely with global practices and should improve market discipline by giving investors deeper visibility into banks' financial strength and risk profiles.
Staying with the banking sector, lenders are now urging the Reserve Bank of India to relax the 3-year operational track record requirement for infrastructure investment trusts or InvITs. Banks argue that the existing rule prevents newly created trusts with high-quality assets from accessing loans, slowing infrastructure monetization and fresh project financing across the country.
And this comes at a time when InvITs and REITs have already unlocked more than Rs 1,50,000 crores through asset monetization. Road sector InvIT assets alone are projected to grow nearly 30% this year to around Rs 3,90,000 crores. Industry participants say more flexible lending norms are essential to maintain momentum in infrastructure expansion and capital recycling.
Central Bank of India is also preparing for the future by launching its International Financial Services Centre Banking Unit at Gift City next month after receiving approvals from both the Reserve Bank of India and the International Financial Services Centres Authority. The move will significantly expand the bank's foreign exchange capabilities, including foreign currency loans, trade finance, and risk management services.
At the same time, the bank is actively preparing for the expected credit loss framework effective from April 1, 2027. It has already provisioned Rs 1,575 crores for Stage 1 and Stage 2 assets and fully provided for Stage 3 assets. That proactive approach should strengthen risk management and improve resilience during economic uncertainty.
Globally, we're also seeing a shift toward integrated economic ecosystems. Japan's Kumamoto Semiconductor Corridor and India's Gift City are increasingly being viewed as strategic growth platforms, combining technology, capital, infrastructure, and talent. Investors are rewarding countries that build coordinated ecosystems capable of supporting long-term competitiveness, technological sovereignty, and supply chain resilience.
And finally, India's private credit and retail fixed income markets continue to gain momentum. 361 Asset Management plans to raise up to $500 million for its sixth private credit fund focused on mid-sized companies and special situations, while Oxiso Financial Services is acquiring 100% of Golden Pie Technologies to enter the retail fixed income space. With Golden Pie already serving more than 16 lakh users investing over Rs 6,000 crores, the deal highlights rising retail demand for diversified fixed income products and signals growing depth in India's debt capital markets.